Good morning and welcome to this daily morning call. It's Thursday, September 20th. We seem to have markets that are continuing to stabilize. The trade war tension seems to have eased over the past few days. China has said that they will refrain from devaluing their currency further, and they're also announcing that they're going to reduce some tariffs maybe as early as October. So it's taken the sting out of the trade war concerns, and we're seeing stock markets and emerging markets react accordingly. And today I'll be joined by Althea and Kim. We're going to take a look at some of the developments based on these. But I think first of all, let's take a look at the bond yields, because really that is we are starting to see some movements there, which could potentially be very important. So if we look at the first chart here, we basically just highlighting the three different yields that we have in the 10-year area. We've got break even, which is the gap between notional and real yields, and then we've got the one that we normally follow, which is the blue line, the top line, and we can see it's broken back above 3%. It's testing the highs from or starting to test the highs from May, which was 312. What we're also seeing on this, while we've seen real yields and nominal yields move higher, break even, i.e. the inflation expectations in the market, remain sidelined. And it basically means that real yields at this stage is moving higher. It's attracting additional funds into the US. But as that happens, we potentially could see another issue for emerging markets because of the rising yields in the US. It's sucking funds out of the rest of the world. So that's something we need to be aware of, but from a technical perspective, I think in the short term it looks like the 10-year note is starting to make some moves here. Kim, what's the futures telling us?
Yes, that's correct. We saw that the 10-year note broke down below the 119 support, and we can see here from the chart that it's moving towards the next support level around 118.10, and from there I expect it to pause a little bit, maybe, but I think the direction, if we look at the overall chart, which we don't have here at the moment, but that's 117.5, which is not even a strong support either. So we don't have many strong supports from here now.
So both the price level and the yields are approaching some critical levels here.
Absolutely, yes.
Althea, we have been talking about the yield curve quite often, because obviously we've seen this up until recently contraction in the yield curve. What's happening here with this move up in 10-year notes?
Yeah, absolutely. I believe that is very important to put this into context because, and especially to look at the 10 years movement with the 2 years movement. The 2 years treasuries have hit a yield of 2.8%, and the yield curve has been steepening of approximately 5 basis points. So right now, the difference between the 10 years yields versus the 2 years yields is 25 basis points. But at this point, you made a very good point about emerging market and distress, which we still believe that is an ongoing risk. But at this point, I believe that it is very important also to look at the domestic US market and trying to understand where weakness can arise from that. And as we have looked at it a few weeks ago, I believe that the high yield space at this point could suffer the most.
And it's quite interesting. I think it was Bloomberg this morning basically showing that the yield curve in China is now above, or the yield spread is now above that of the US. So it could potentially indicate that we are seeing a divergence between the two. China potentially picking up some momentum on the back of renewed spending plans, which is also helping the metal space. Let's just stay with the US before we move on, because there's been some interesting developments. Because it looks like the Dow is moving higher, but the Nasdaq is not really going anywhere. And Nasdaq really has been the engine for this big rally we had in the US.
Yeah, that's correct. We have seen Nasdaq has been the engine for the better part of this year. Excuse me. But it's paused a little bit. The past 8-10 days is more or less moved sideways, as we can see from the chart. The 7,400 support level could come under pressure here the next couple of days. It has broken this rising trend line, as you can see, the lower rising trend line here. It's broken that, and we are very close to this support level. Interesting to see that the Dow and also a little bit the S&P has been strong lately, but Dow is actually very close to all-time high again.
Yeah, it's quite significant. But obviously, if we start to see some weakness in Nasdaq, then it is where a lot of the money is centered. Yes. So we need to keep an eye on some of these major Nasdaq stocks. Just, I think we want to stay on the interest rate theme just a little bit a while longer, Althea, because if we move to Europe, we're seeing a spread between Germany and Italy starting to narrow a bit. Is because it's going better in Italy, or are we just seeing German bond yields moving higher? What's going on there?
Well, definitely in the past few weeks we have seen an improvement in the Italians' headlines. What we have seen is that there is an alignment from the government to accept the restrictions of the European Union to have the deficit below the 3%. However, things are slowly changing, and what has risen in the past few days is that not only there might be a risk within Italy against the EU and the budget talks, but also there might be some frictions within Italian politics, and Italian political instability is rising. And this is because yesterday we have seen the leader of the Five-Star Movement saying that the 1.5% deficit target that Minister of Economy Tria has mentioned, it's too low, and he wants to prioritize some policies that are incredibly expensive, such as a flat tax and a minimum wage for citizens. And what we've seen yesterday is, of course, that the BTPs have started to fall again, and until we don't have clarity on how the government is going to approach the European Union, we are going to see more and more volatility.
So on the chart that you brought us today, we can see we come down a bit, but as long as that risk prevails, you think that the upside risk of another widening is still
absolutely.
Still the main risk?
This is something that actually Kim and I have looked at in the past few weeks. What worries us the most is that also on a technical point of view, the 10 years BTP shows signs of weakness, and of course, although there has been a rebound, there is plenty of room to make us think that they could fall further.
Okay, thank you very much. Should we just take a quick look at the DAX, Kim?
Yes, just a follow-up to what I sent out a few days ago. It seems like we got this correction. It could still move a little bit higher. It paused around the 50% retracement yesterday, but I think there's a little bit room up to around 12,320. Could potentially go to 12,425, but I'm not quite sure about that, where it will hit this. You can see this falling trend line. It is like falling channel here before I believe we will resume the bearish trend on the DAX.
And as usual, obviously, we need to keep a very close eye on trade war, because as we've seen recently, the yuan's movements has had quite a significant impact on the European market, especially the DAX being so export orientated. Okay, I think we're starting to run out of time. Let's just take a brief look at some of the commodity moves we've seen over the past few days here. If you look at these are some of the numbers from the weekly inventory report we had yesterday from the US. And crude oil is trading higher this morning, and we're once again challenging key resistance in Brent at $80. What's basically happened is that crude oil inventories are dropping. They dropped for the fifth consecutive week yesterday, and the reason for that is very strong refinery demand. That's the middle one. You can see we're well above the longer-term averages. Also, exports are continuing to show signs of strength. So oil is leaving the US, and that's obviously reducing the stocks. That's supporting the oil market. So we're seeing oil market once again challenging key resistance, and again, if some of the emerging market fears start to fade, then that we potentially could have enough support from the falling supplies from Iran to make a break. So 80 is really key there. On the metal space, we're seeing a little bit of divergence here, because the fact that the trade war tension has eased somewhat, and also China has announced some initiatives to increase spending. Basically, as you can see on the chart here, shows that the high-grade copper is back testing resistance around the 275 area. We're just below that today, but that's definitely one we should keep an eye on. It potentially, if we start to break above, we could potentially have seen the worst for now. But this is quite a significant level. Gold, really not much to say. RSI is right bang in the middle, and the crude oil, the price is more or less also in the middle of the range. We need a break. So far, we haven't got it. Real yields moving up in the US is not supportive ahead of next week's FOMC. Just finally on the calendar today, basically interest rate announcements are in focus. We got the Swiss first out, and then we got Norway later, where there is expectation for a 0.25% rate hike. So look out for that. Retail sales in the UK, interesting as we have all these Brexit worries at this stage. And then sometime today we should see an announcement from South Africa. The rate hike announcement is really not priced in. Only 3 out of 16, according to Bloomberg, is looking for a hike. So we have seen the rand strengthened by 7% over the past few weeks, and if they do hike, then potentially could add some additional support. So look out for that one as well. That's it from us. We'll be back again tomorrow. Thank you very much.